In the dynamic and often volatile world of global energy, few names command as much weight and historical significance as Chevron Corporation. From its origins in the nascent American oil rush to its current position as a multinational energy behemoth navigating the complex transition to a lower carbon future, Chevron's journey is a compelling case study in corporate evolution, strategic adaptation, and market dominance. For investors, understanding this trajectory is not merely a history lesson. It is crucial for assessing the company's resilience, its strategic foresight, and its potential to generate long-term value in an industry undergoing a profound transformation. Chevron, a company with roots stretching back over 140 years, has consistently demonstrated an ability to reinvent itself through strategic mergers, technological innovation, and geographic expansion. Today, as it stands at the crossroads of traditional fossil fuels and emerging renewable technologies, we will dissect the pivotal moments that shaped this oil and gas titan and evaluate its strategic pivot towards the energy landscape of tomorrow. This analysis will provide a comprehensive perspective on how Chevron has built its empire and how it is positioning itself to not only survive, but thrive in the new energy era. The genesis of Chevron can be traced back to 1879 with the founding of the Pacific Coast Oil Company, a pioneering enterprise that emerged amidst the burgeoning oil boom on the west coast of the United States. This relatively modest venture, however, was destined for a much grander stage, in a move that would forever alter its destiny. The company was acquired in 1900 and subsequently became a key component of John D. Rockefeller's legendary Standard Oil empire in 1906, rebranded as Standard Oil of California, or SOCAL. It was integrated into the most powerful industrial monopoly of the era. Following the landmark 1911 Supreme Court ruling that broke up the Standard Oil Trust, SOCAL emerged as an independent entity, retaining a significant portion of the West Coast market. This early period was not just about domestic consolidation. It was characterized by an ambitious and forward-looking international strategy. A critical turning point came in 1933 when Sal embarked on a strategic joint venture with the Texas company, which would later be known as Texaco. This partnership, formed to secure and develop vast oil concessions in Saudi Arabia, was named the California Arabian Standard Oil Company, or CASOC. This venture was a masterstroke of geopolitical and economic foresight, granting the American companies unprecedented access to what would prove to be the world's most prolific oil reserves. By 1944, this entity was renamed the Arabian American Oil Company, or Aramco, laying the foundational pillars for decades of global energy influence and securing a supply chain that would fuel post-war economic expansion across the globe. From a financial and strategic standpoint, this early history demonstrates a core competency in identifying and capitalizing on high-potential assets, a trait that would define the company's growth strategy for the next century. The decades following World War II were a period of relentless expansion and strategic repositioning for Standard Oil of California. As global energy demand soared, SOCAL aggressively expanded its upstream exploration and production activities, while simultaneously building out its downstream refining and distribution networks. A key element of this global push was the Caltex brand, a joint venture with Texaco that became a ubiquitous symbol of American energy prowess in markets across Asia, Africa, and the Middle East. This international presence provided crucial geographic diversification, mitigating risks associated with dependency on any single region and creating a robust, integrated global supply chain. However, the most transformative event of this era, and arguably in the company's history up to that point, is the monumental merger with Gulf Oil in 1984. Gulf Oil, itself one of the original Seven Sisters that dominated the global petroleum industry, was a formidable player with extensive assets. The acquisition, valued at a staggering $13.3 billion, was the largest corporate merger in history at the time. This wasn't merely a consolidation. It was a strategic masterstroke that dramatically increased SOCAL's reserves, production capacity, and market share, catapulting it into the uppermost echelon of global energy giants. To reflect this new, vastly expanded corporate identity, and to leverage a brand that had already gained significant consumer recognition, Standard Oil of California officially changed its name to Chevron Corporation in the same year. This renaming signaled a definitive break from its regional origins and the dawn of a new era as a truly global, integrated energy corporation, setting the stage for even more ambitious growth in the decades to come. Entering the new millennium, Chevron was not content to rest on its laurels. The corporate strategy shifted towards aggressive consolidation to further solidify its market position and achieve unparalleled economies of scale. This ambition culminated in the landmark 2001 acquisition of Texaco, its longtime partner and major competitor. The merger, valued at approximately $45 billion, was a reunion of the two entities that had jointly established the Calusa and Caltex ventures decades earlier. This transaction was transformative, creating the second-largest oil and gas company in the United States and the fourth-largest publicly traded energy company in the world. From an investment perspective, the deal unlocked immense synergies, integrating complementary asset bases, streamlining operations, and significantly enhancing Chevron's competitive posture against rivals like ExxonMobil and Royal Dutch Shell. The newly formed Chevron Texaco possessed a formidable portfolio of upstream assets and a powerful, globally recognized downstream brand. Building on this momentum, Chevron executed another strategically significant acquisition in 2005, purchasing Chevron Corporation for approximately $18 billion. This move was particularly noteworthy for its strategic focus on the Asia-Pacific region, a critical growth market for energy demand. Chevron brought with it substantial natural gas reserves and production facilities in Thailand, Indonesia, and other key Asian markets, perfectly complementing Chevron's existing portfolio and deepening its foothold in the world's fastest-growing economic zone. These two major acquisitions within a 5-year span were not just about getting bigger. They were calculated strategic moves that fortified Chevron's resource base, expanded its geographic reach, and cemented its status as an undisputed energy supermajor, positioning it for robust profitability and shareholder returns for the foreseeable future. In the contemporary era, Chevron finds itself navigating a dual mandate, optimizing its vast traditional energy operations while strategically investing in the technologies that will define the future of energy. The core of Chevron's business remains firmly rooted in the exploration, production, refining, and marketing of crude oil and natural gas. The company operates massive, capital-intensive projects across the globe, from the deepwater fields of the Gulf of Mexico to the Gorgon and Wheatstone liquefied natural gas LNG facilities in Australia and the Tengiz expansion project in Kazakhstan. These legacy assets are the cash flow engines that fund the corporation's operations, drive shareholder returns through dividends and buybacks, and crucially finance its pivot toward a lower carbon future. Recognizing the inexorable global trend towards decarbonization, driven by policy, technology, and shifting consumer sentiment, Chevron has begun to make calculated, pragmatic investments in clean energy and sustainability. The company is actively developing and forming partnerships to produce sustainable aviation fuel, SAF. It's a critical pathway to decarbonizing the aviation industry. In parallel, it is investing in carbon capture, utilization, and storage CCS projects, aiming to mitigate emissions from its own and other industrial operations, a strategy that allows it to leverage its extensive geological and engineering expertise. Furthermore, Chevron is exploring the potential of green and blue hydrogen, viewing it as a long-term vector for clean energy, particularly in transportation and industrial applications. While its investments in wind and solar power are more measured compared to some European counterparts, the company is nonetheless allocating capital to renewable energy technologies that align with its existing business model and capabilities. This transitional phase is a delicate balancing act. Chevron is positioning itself not as a company abandoning its core business, but as an integrated energy provider, evolving to meet the world's complex and growing demand for affordable, reliable, and ever-cleaner energy solutions. In conclusion, the corporate saga of Chevron Corporation is a powerful illustration of strategic foresight, adaptability, and the relentless pursuit of scale in the global energy sector. From its origins as a regional player within the Standard Oil monopoly, Chevron has masterfully navigated over a century of geopolitical shifts, technological disruptions, and market cycles. Its history is defined by transformative mergers, most notably with Gulf Oil and Texaco, that have consistently reshaped its competitive landscape and fortified its position as a global supermajor. These strategic consolidations were not merely about size, but about securing critical resources, achieving operational synergies, and expanding its geographic footprint into high-growth markets. Today, Chevron stands as a testament to this legacy, operating a vast and profitable portfolio of traditional oil and gas assets. Yet it is the company's forward-looking strategy that will ultimately determine its long-term investment merit. By pragmatically investing in a diversified suite of lower-carbon solutions, including CCS, hydrogen, and renewable fuels, Chevron is attempting to architect its next chapter. It is charting a course that seeks to balance the present-day reality of global energy demand with the future imperative of decarbonization. For investors, the key question is whether this measured, disciplined approach to the energy transition will prove more resilient and profitable than the more aggressive pivots of its peers, as Chevron continues to evolve its journey from oil empire to a future energy provider will remain a critical narrative for anyone seeking to understand the enduring dynamics of capital, innovation, and strategy in one of the world's most essential industries.